Welcome to this explainer. Okay, picture this for a second. You've got an absolutely amazing business idea. I mean, the prototype is flawless, customers are literally begging for it, and you are totally ready to go. But there's one glaring, stressful problem. You just don't have enough money to actually launch or grow the thing. It's this universal sinking feeling that pretty much every entrepreneur goes through. So, what do? Do you beg a bank? Pitch to investors? Drain your own hard-earned savings? Well, today, we're going to master the fundamentals of business financing. And don't worry, we're absolutely not using any complicated Wall Street jargon here. Instead, we're going to decode the whole process using a lens you already know perfectly: your everyday, run-of-the-mill household budget.
Now, you might be wondering, how on earth is funding a startup just like managing your household budget? It sounds a little strange at first, right? But getting a business loan is exactly like trying to get a personal mortgage, or maybe a car loan, using your family's monthly budget. The rules of the game are surprisingly identical. So in this explainer, we'll unpack exactly how successful businesses finance themselves at every single stage, and we'll decode how banks actually decide whether or not to hand over their cash, all by treating your business exactly like a household.
All right, Section 1, Funding Your Big Idea, the basics of business financing. Okay, let's dive right into this. Every single business needs money to survive, just like a family does. Think about your own household budget for a second. Your salary pays for the essentials, right? You've got groceries, rent, maybe a little entertainment on the weekend if you're lucky. Well, a business budget operates under the exact same laws of physics. Revenue comes in, and boom, it immediately has to pay for inventory, office space, equipment, advertising, and of course, employee salaries. Now, in a perfect fairy tale world, a business earns enough profit to pay every single one of these expenses from day one. But let's be real here, almost no business actually starts out that way. And that is exactly when external financing becomes a total necessity.
When you finally hit that point where you really need outside money, human nature kicks in and makes us ask one simple question: can I borrow money? But here's the thing, the most important question, the one literally every lender on the planet is actually asking is, can I pay it back? It doesn't matter if you're tapping into your personal savings, hitting up business partners, pitching wealthy investors, or walking into a traditional bank. That core question of repayment is the absolute foundation of all financial trust.
Moving to Section 2, the repayment capacity test, what banks really care about. Let's look at exactly how banks evaluate your business. See, lenders don't just hand out money because your idea sounds exciting or revolutionary. Just like a mortgage lender scrutinizing a family's finances, they only care about the cold, hard math. So, imagine your business brings in $20,000 in monthly revenue. Sounds pretty great, right? But after paying salaries, rent, electricity, taxes, and suppliers, which are basically your business's groceries and rent, you have $15,000 in expenses. Subtract that out, and you were left with $5,000 at the bottom line.
Notice that leftover $5,000 figure. In the banking world, this specific chunk of leftover cash is called your repayment capacity. It's the exact same math a family uses to figure out if they can safely afford a new $500 monthly car payment. That $5,000 proves to the bank that you actually have the cushion to afford monthly loan payments. But think about it. If every single dollar of your revenue was already eaten up by expenses, the bank sees a massive red flag. No repayment capacity means absolutely zero confidence that you'll make your payments. It's really that simple, guys. No margin, no loan.
Section 3. Why startups use personal savings. The reality of early business phases.
All right, here is a harsh reality check that a lot of first-time entrepreneurs completely miss. Most startups simply do not make a profit immediately. In month 1, you're losing money. By month 6, yep, you're still losing money. Even at month 12, the bank account might still be bleeding. Some companies literally run in the red for years. Imagine if you walked into a bank for a personal loan and said, hey, I just quit my job to find myself, I have zero income, but I have a really great feeling about next year. I mean, they would politely show you the door, right? Well, banks treat brand new businesses the exact same way. They avoid lending large amounts to startups simply because there is zero repayment capacity yet.
And because of this timeline, most entrepreneurs have to turn to alternative sources early on. That usually means relying on personal savings, family support, co-founders, or angel investors. Why them? Because these sources are willing to accept a much higher level of risk. They're investing based on a personal belief in you and the sheer potential of the business idea, rather than just staring at the immediate demanding financial numbers that a bank requires.
Section 4. Solvency and the backup plan. Securing the loan.
Let's fast forward a bit. Say your business is finally making money.
You go to the bank, you show them your awesome repayment capacity, and they are impressed. But banks are naturally cautious creatures. They are always going to ask themselves this critical, worst-case scenario question. What happens if this business just stops paying us? This introduces a concept called solvency. Solvency simply means having valuable assets that can guarantee the loan. Think of it as the bank's ultimate backup plan. In the personal finance world, if you can't pay a personal debt, you might have to pawn a valuable asset, or a lender might repossess your car. Well, solvency is exactly that, just on a business scale.
And this brilliantly illustrates exactly what we're talking about. In practice, this backup plan usually takes the form of collateral. Banks look for tangible assets to secure the loan, things like property and buildings, company vehicles, or actual cash savings. If the borrower fails to repay, the bank can recover part of its money by claiming these assets. But hey, here's a little secret to keep in mind. Banks don't actually want to own your warehouse or your fleet of delivery trucks. They're in the business of finance, not used car sales. They would much rather receive every payment on time than go through the massive headache of taking ownership of your assets.
Section 5. Proving your financial health, unlocking growth and opportunities. As your business matures, literally everything changes. Your customer base grows, your revenue goes up, and your cash flow finally becomes stable and predictable. Your business household is fully secure. When this happens, your repayment capacity becomes undeniable, and this causes a massive, fundamental shift in the bank's mindset. They stop asking, can this business even survive? And they start asking, how much money can we lend them to help them grow? This is precisely why a lot of the most successful companies wait until they have a proven stable income before taking on major bank loans.
So let's see how this actually translates into the application process. When you are finally ready to apply, you can't just cross your fingers and promise the bank you're doing well. You actually have to prove it. In the personal world, you'd hand over your W-2s and your pay stubs. In the business world, you hand over a specific set of documents: income statements, balance sheets, tax records, details on existing loans, and your complete financial history. These documents are the ultimate proof of your financial health. They show the bank exactly what your income, expenses, and debts are. The stronger these records are, the easier it becomes to secure the funding you need to really scale things up.
Conclusion: borrowing to fuel growth.
As we wrap up this explainer, I really want you to remember that the smartest entrepreneurs out there do not borrow money simply because they have the option to. They borrow because they have a meticulous plan to generate way more income than the loan actually costs them. Let's do a rapid-fire summary of our 4 key lessons today. Number 1, financing exists to help businesses grow. 2, banks will always evaluate your repayment capacity first. They want to see that leftover cash. 3, collateral or solvency acts as a safety net that really increases their trust. And 4, meticulous financial records open the door to much bigger opportunities. Ultimately, business financing isn't just about getting your hands on a giant pile of cash, it's about proving you have the discipline to run your business just as tightly as a well-managed household budget.
So, I want to leave you with this final thought to really ponder today. Take an honest look at your own current situation. Is your business idea currently just a dream hoping for a handout? Or is it a financially viable plan, complete with real repayment capacity and rock-solid records, truly ready for explosive growth? Treat your business exactly like your household, master the math, and I promise you the funding will follow. Thanks so much for joining me on this explainer, and keep building.